So here are some important points to think about with regard to bonds, corporate bonds, and this goes for government bonds also. In general, the longer the bond's maturity, the higher the interest rate that the company must pay you if you have their bond. And that's obvious because you're taking more risk, right? The greater the risk, maturity risk now, the greater the return. In addition, the larger the size of the offering, the lower will be the cost of the bond. Okay, investment firms will charge you a smaller amount of money if you do a larger offering. Makes sense, right? Anything larger, you get a reduction in price. It's like when you go into a store and you buy a large quantity of something, they'll give you 10% off. Okay, now this should be very obvious. If your company's in trouble and could possibly default, the person who buys your bond is going to want a higher rate of return. Again, the greater the risk, the higher the return. And basically, how do you determine the basic component of the interest rate on a bond? And that comes from the the cost of money in the capital markets, or the real rate of return. And then we add a couple other terms to that: default risk and inflation premium, and we go from there. Right? First we look at the risk-free rate, and then we add components from there. All right. So there are some bonds called convertible bonds. And what they allow you to do is you can buy this bond and you could convert it at some particular period in time into a number of shares of common stock. And of course, if you hold one of these convertibles, you're only going to do the conversion if the stock is greater than the set conversion price. When you buy this bond, there's going to be a set conversion price. And of course, you'll only convert if if a profit is there. Now, a call feature for a corporate bond is, let's think about this for a minute. If a company issues a bond and it's paying you a 10% coupon, and if interest rates on bonds go down in the general market, and they could issue new bonds for, let's say, 4%, wouldn't it make sense for the company to basically call your bonds back and basically say, I'm not paying you 10%. Here's your money back. I'll basically pay new bondholders 4%, and they would issue a new offering. And they're always going. The call price is the price at which a bond is going to be repurchased at the call. The call feature prior to maturity. And basically, the premium will be above and beyond the par value. So it's important to know these two terms. And there are many people who do buy convertible bonds, and you get something extra, so you have to pay a little bit extra for convertible, right? You don't get something for nothing. So the call premium, the extra money you'll get will be equal to 1 year of coupon interest, and it'll compensate the holder for having it called, right? So you're taking more risk, so you got to get a little bit more money. So again, here's what we just said, right? Corporations are going to exercise it if interest rates fall, and they could basically refund the issue at a lower cost. And again, here's what we said. There's a higher rate to investors because they're taking more risk with the call feature. All right, so there's three ways to get the yield for bonds. The current yield is simply the current price divided the coupon rate. The coupon rate. Let's say $90, 9%, right? $90 divided by the current yield, the current price. That'll give you the current yield. Yield to maturity is the maturity you will get if you hold the bond until it matures. Just like the term says, yield to maturity, that's what you will receive. And the yield to call is basically if the bond is called, with the extra sweetener or premium you extra get for having it called, what yield did you get? And there's equations for all these, of course, and you can find these in Excel. All right, so here's an example. So remember this. This is redundant here. A par means face, and it also means 1,000. So when you see the word par, it typically always refers to $1,000. All right. So all bonds are quoted as a percentage of par. So looking at the price here. So when you look in the newspaper, $1,000 par value bond that has the price shown this way. The real price is, you just got to move the decimal one place over to here. See right there? So the price would be 940.07, right? So this is basically 94.007%. You see that? And you just multiply that by 1,000. 0.94007 times 1,000. So corporate bonds are quoted in dollars and cents. And you can see, again, a price of 103.143 percent. This is percent. Is 1,031.43. Now the price has gone up because interest rates have gone down. Remember that old saying, if interest rates go up, the price of a bond always goes down, and vice versa. That you should know. If you have any questions on that, email me. All right, so here's some different coupon bonds, corporations, right? And here's what they're paying, the coupon. This is guaranteed fixed. This will never change over the time, unless you have some strange different kind of bond. Okay? But unless it's like a floater or something. And here's the date when you get your money back, when the bond matures. Here's the current price. Now you'll notice the price has gone down in this case from par. So you can see the yield is up. Everyone see that? Higher than the coupon. Again, price has gone down. The yield is much higher than the coupon. Here the price has gone up. So the yield has gone down compared to the coupon. And then and vice versa for all these. So if you have any questions, let me know. So you should see that. Here again, look at here. Here the yield has gone down, so the price is up. Everyone see that? Okay, and here is Moody's and Standard & Poor's and the different ratings. Here's the ratings Moody's gives. Again, if you have really good bonds, they're rated prime. And here's how Standard & Poor's rates them. And when you get down to, let's say, double B for Standard & Poor's or BA, these become, from this point down, it's junk. You'll see the word junk bonds. All right, so I'll skip over this ethics. I'm sure you guys take a class in ethics or something. There's always games that go on in with regards to finances. All right, so there's all different types of bonds here. And you can see the different variations in bonds. This is just an informational slide for you. And, of course, there's international bonds. And a Euro bond is just a bond issued by an international borrower and sold to investors in countries with currencies other than the currency in which the bond is denominated. So if a bond is denominated in Italian lira, and it's sold in France, that's a Euro bond. And a foreign bond is a bond issued in a host country's financial market in the host country's currency by a foreign borrower. So anyway, there's different types of bonds. And here's a lot of, again, here I mentioned junk bonds, and here's a zero coupon bond. By its name, you should know zero coupon bond pays no coupons, and you buy it at a deep discount, and it will go up steeper in time, and you basically will get all the money at the end, except you do have to pay taxes on the money you don't receive. All right, so let's get to some valuation. How do you value a bond? You look at the cash flows, the timing, and how much risk, which will determine the required return. So these are the three key items that you got to look at when you price a bond. And they give you some examples about valuation in general. How do you value stocks? And if you have an oil well, and you've seen people value paintings and certain items that value is placed on. Okay? And basically things are valued depending on, sentimental value. And so here's the personal finance examples of art galleries, and you can go through these and see how things are financed. So here's the basic valuation model for anything. The value of anything, valuation, is equal to the future, and I say sum of the future cash flows that basically it's going to get. So let's say if you're looking at Disney World, if Disney has a bang up year every year, and they basically, the company brings in a lot of cash, of course, eventually over time it'll be reflected in their dividend, or however else maybe the earnings, and that's how the company will get valued. Valuation is a separate course unto itself in how you value things. And here's the appropriate required return investors require. And again, here is some examples of Michael's stock here, personal finance. The required return in this case is 20%. And here's the cash flows that he expects to get in the future. And here is the example with the painting. And again, this is an annuity, 5 years, getting 15%. And they're valuing the stock and they're valuing the painting here. All right, so let's look at bonds now. This is your basic equation for valuing a bond. Okay? Now, this is a bond that pays, I'm going to make very clear, a coupon once a year. There's going to be another equation for a bond that pays a coupon every 6 months or semi-annually or twice a year. Same thing. But this is your coupon, annual interest in dollars, okay? This is your required return. This means sum, right? So this is the annuity portion of the coupons you're going to get over the life of the bond, okay? And this M is the par value, which is typically $1,000. And basically, this is the required return. So this is the single portion. So this will be the present value of the single amount of money that you will get in the future. And this will be the present value of the coupons that you'll receive on an annual basis. So this is an important equation. And this is already built into Microsoft Excel. If you bring up the PV function on Microsoft Excel, you will see that. So here's a company that's got a 10-year bond, and it's got a 10% coupon interest rate, and it's got a $1,000 par value. So right away, without doing any major math, 10% of $1,000, you're going to get $100 a year in a coupon. And you can do whatever you want. You can reinvest that. Okay? So that's the important things to know here. And because the required return is 10 and it matches the coupon, the bond hasn't gone up or down. It's still at par, and that's reflected in the price here. Everything comes back to the present, but again, the interest rates haven't changed, and you're still at par value. But if the required return would have moved, this would have been up or higher or lower, depending on which way the required return moved. And you could do that again. Here is how you do it in Excel. Here is the calculator function, if you got a financial calculator. All right, so about 13.5 minutes. We'll pick up here, okay? All right, talk to you later.